The COVID-19 pandemic dealt a major blow on the whole world. Aside causing a global health crisis, it resulted in a sharp decline in economic activity, such as has not been seen in recent history. In just a few months, the COVID-19 pandemic turned from a health crisis into a global economic crisis, causing a much larger contraction in global GDP than the global financial crisis of 2008. But the economic rescue team of the United States, the Federal Reserve, came to the rescue. As we might know, the responsibilities of the Federal Reserve are evaluating current market conditions and deciding whether to make changes to the money supply. It makes changes to the money supply by lowering or raising the discount rate banks pay on short-term loans. Also, the Fed buys or sells securities from banks to increase or decrease the amount of money these banks have in reserves. This way, it is able to control inflation. This is how it happens. When the Fed increases the money supply faster than the economy is growing, inflation occurs. In this situation, the increase in money circulating in an economy is higher than the increase in goods produced, such as, there is now more money chasing a fewer number of goods. For example, imagine an economy with $100 and 100 oranges. If everyone were to take their money and buy all oranges, the average price per orange would be $1. Now imagine the government increased the money supply by 10% to $110, but the economy was only able to grow output by 5% to 105 oranges. Now, since the amount of money increased more than the capacity to grow oranges, the average price per orange now increased to roughly $1.05. This describes how much impact money supply has on inflation. And so, adjusting monetary policies is a tool used by the government to control inflation. Because the COVID-19 pandemic has tremendously impacted the U.S. and global economies, the U.S. government decided to respond to the crisis with the best strategies available. So it enacted a number of policies to provide fiscal stimulus to the economy and relief to those affected by this global disaster. The Federal Reserve also took a series of substantial monetary stimulus measures to complement the fiscal stimulus. Before we go on, let's consider the impact the COVID-19 pandemic has had on the U.S. economy. The COVID-19 pandemic started affecting the world economy even from its early days, sending the U.S. economy into a recession in February 2020. This crisis also affected the U.S. stock market, pushing it into bear market territory in March 2020, with the S&P 500 not recovering to pre-pandemic highs until June 2020. The labor market was not left out in the shakings as the unemployment rate rose as high as 14.7% in April 2020, the highest ever experienced since the Great Depression. In the second quarter of 2020, the U.S. economy, which is measured by gross domestic product, fell by about 32%. The GDP rebounded in the third quarter and ended the year with an increase of 4.0% year over year. Now to the implemented fiscal stimulus. The Fed's stimulus measures fell into three basic categories: interest rate cuts, loans and asset purchases, and regulation changes. In the case of the loans and asset purchases, they came in as general purchases made as part of quantitative easing and repurchase operations where the Federal Reserve buys assets directly. The Fed also created specific lines of credit and programs where it financed loans from the primary market corporate credit facility through special purpose vehicles. Then, it lends money to companies through the vehicles, which use the money to fund operations. All of these efforts were combined to ensure that the U.S. would not suffer a liquidity crisis similar to that of the Great Recession. For interest rates, the Fed cut its target range for the federal funds rate twice in March 2020. It was cut first by 0.50% to a range of 1% to 1.25%, then by 1.00% to a range of 0% to 0.25%. Now, this is quite notable because since the Great Recession, the Fed had not increased interest rates over 0.25%. The Fed officials made the move to increase the target rate range, which remained at rock-bottom levels to combat the pandemic. However, the Fed made a series of dramatic increases to the federal funds rate in 2022 and again in January 2023 to combat rising inflation. Although the COVID-19 crisis cost everyone, it was particularly worse for the low-income citizens. In fact, the early days of the pandemic were among the darkest moments in recent history for the unemployed and low-income Americans. But the government did all they could to reduce the effect of the crisis. In 2020, the Trump administration provided relief by signing a $2 trillion package that sent $1,200 checks to every American who earned less than $75,000, as well as enhanced unemployment and forgivable business loans. When Joe Biden became president, he followed with additional stimulus money. In total, American households received over 472 million pandemic relief payments worth $803 billion. And out of this, nearly $5 trillion went to households, businesses, local governments, and other institutions. Interestingly, the programs worked, at least as far as their intended purpose. Material hardship in U.S. households fell sharply as a result of the payments. But it wasn't long before it started to get really ugly. Even though the COVID-19 crisis has eased greatly, people still argue over whether the early pandemic stimulus fueled the high inflation that followed post-pandemic, or if high prices were caused by other factors like China's tight lockdown policy that broke supply chains. Well, according to a new study by the St. Louis Fed, the truth is that government stimulus was indeed responsible for the U.S. inflation. The authors found that stimulus payments led to substantially more demand for goods in the run-up to 2022, but industrial production at the time was unable to keep up. The result was a higher amount of excess inflation, they said. During the compulsory lockdown, while white-collar American workers retreated to their laptops and home offices to work remotely, many other Americans weren't as lucky. Unemployment surged in the first half of 2020 and permanent business closures piled up. The number of people living below the poverty line went up, and more than half of Americans were expected to run out of savings before the year closed out. The stimulus payments served as an essential lifeline for low and moderate income Americans whose livelihoods were hit hardest by the pandemic, and may have helped lift nearly 12 million people out of poverty in 2020 alone, according to the Census Bureau. Meanwhile, federal stimulus to businesses amounted to $1.7 trillion throughout the pandemic. But while more than half of Americans reported using their stimulus money to pay for basic necessities, including food and rent, recipients with higher incomes tended to save it. Therefore, due to greater disposable income, consumer spending increased in 2021. But with fears of COVID transmission and travel restrictions worldwide still in place, that spending was overwhelmingly on goods rather than services, contributing to the market imbalances that lifted the inflation rate in February 2022. While stimulus checks helped keep consumption at a relatively high level, manufacturing did not increase and so wasn't able to keep up with the demand. By stimulating demand without boosting supply, our results suggest that fiscal support contributed to increased excess demand pressures in goods markets, the authors wrote. The findings of the research align with another study from the Federal Reserve Bank of San Francisco that also identified short-term inflationary effects linked to fiscal stimulus in 2020 and 2021. This study found that stimulus issued directly to consumers was more inflationary than stimulus for businesses. The St. Louis Fed survey also suggested that higher-than-expected consumer spending and supply chain issues may have amplified each other to feed rising inflation. This policy was successful at boosting consumption, which, together with a relatively inelastic supply, may have led to supply chain bottlenecks and price tensions. The authors continued. However, the Fed's St. Louis and San Francisco studies both noted that the social benefits of stimulus payments could potentially outweigh the negatives of inflation. One should also recognize the positive role played by generous government support throughout this unprecedented crisis. The large spending supported a strong economic rebound, with both GDP and employment recovering at a remarkable pace, likely preventing worse outcomes despite the price pressures that may have resulted from the spending, the St. Louis authors added. The Federal Reserve and government stimulus was meant to ease the effects of the pandemic and reduce inflation, but in the long run, they ended up adding to the increased inflation rates. The good thing is, the world has learnt from this mistake, and so better policies will be implemented in the future. That's it. Do like this video and subscribe to this channel if you haven't. See you in the comments.